Welcome back to the Deep Dive. It is Monday, January 19th, 2026. And I have to be honest with you, I've been sitting here with my coffee, just looking at the news tickers this morning, and I'm really trying to make sense of the world right now. It feels like a very turbulent start to the year. I mean, I'm looking at these headlines. We've got escalating tariff tensions between the U.S. and the EU over Greenland, which that feels like it came out of nowhere.
Right.
Then on the other side of the world, there's all this news out of China about a deepening property slump. It just feels like the global economy is holding its breath.
It certainly is a chaotic backdrop. You look at those headlines and you just see volatility everywhere. Uncertainty is really the only certainty we have at the moment.
And that uncertainty is actually where I want to pitch our tent today, because amidst all this geopolitical noise, the tariffs, the trade wars, there is a very specific and very worrying forecast coming out of the United States. Analysts are starting to use the word crash again regarding the U.S. housing market. They aren't just saying slow down anymore. They are warning of a severe correction starting, well, right now in 2026. And my immediate reaction is, okay, that's bad for the U.S., but our mission today is to figure out what that means for the Caribbean.
Specifically Jamaica.
Right. The old saying is, when the U.S. sneezes, the Caribbean gets pneumonia. That's the conventional wisdom. So if the U.S. housing market catches a cold, does Jamaica's property market get sick?
Right.
Or, and this is what I'm trying to wrap my head around, is it possible that the data tells a different story this time?
That is the pivotal question. And you're right to question that conventional wisdom. If you look at the raw data coming out of Jamaica today versus the red flags waving in the U.S., it is not a mirror image. It's a much more complex relationship than just, U.S. down, Jamaica down.
So let's dive into this. We are working off a source article titled, "Could a U.S. Housing Crash Reshape Jamaica's Property Outlook?" from Jamaica Homes News, plus a whole stack of market updates from this morning. I want to start with the catalyst. What exactly is happening in the U.S. market right now to make analysts scream crash?
Okay.
Because, we've heard people crying wolf about a housing bubble for years.
No.
Why is January 2026 different?
It's different because the math is finally broken. The core issue, the one the analysis really zeroes in on, is what they call an unsustainable divergence.
Unsustainable divergence.
Yeah. It's just a fancy way of saying there's this massive widening gap between what people earn, household incomes in the U.S. and the price of a home.
The affordability gap. But hasn't that been true for a decade?
It has, but not to this degree. Think of it like a rubber band. You can stretch it for a long, long time, but eventually the tension becomes too great. Over the last few years, median home values in the U.S. have just risen at a pace that wages simply haven't matched. We were talking about a scenario where home prices have jumped 40–50% in some areas, while wages have maybe moved 10–15%. You just reach a point where the people who actually live and work in these cities physically cannot clear the bank's requirements to buy the homes.
So the buyer pool just evaporates.
Essentially, yes. And the thing that is snapping the rubber band right now, the catalyst, is the shift in mortgage dynamics. We're seeing data from the Federal Reserve and market trackers like Zillow showing that higher interest rates are cementing themselves as the new norm.
So we aren't going back to 3% mortgages.
No, and that's the reality check. For a long time, people held on to the hope that, rates would drop back down, making those high prices affordable again. But the realization setting in now, in 2026, is that cheap money is gone.
I see.
Because of that, we're seeing the early signs of price softening in parts of the U.S.
Which is the polite economist way of saying prices are falling.
Correct. And when prices start to fall in a market that is that highly leveraged, panic can set in very, very quickly.
Okay, so that's the U.S. situation. Prices too high, wages too low, rates are up, and the correction is starting. Now, let's build the bridge to Jamaica. I think the assumption a lot of our listeners make, and I'm guilty of this too, is that Jamaica is economically just a suburb of the U.S. Like, if Florida real estate tanks, Kingston must be next. Why is that kind of linear thinking dangerous?
Because it ignores the mechanism of how economic pain is transmitted. Jamaica is an island geographically, but economically it's connected by these specific pipes. The source material identifies three main channels through which this U.S. mess travels to Jamaica.
Okay, what are they?
Capital flows, borrowing costs, and, sentiment.
Let's break those down because capital flows sounds a bit abstract. When we talk about capital flowing from the U.S. to Jamaican housing, who are we actually talking about?
We are talking about the diaspora.
Okay, the auntie in Miami.
The auntie in Miami, the cousin in London, the retired couple in New York.
Yeah.
This is the diaspora factor. Just a massive chunk of investment in Jamaican real estate comes from Jamaicans living abroad.
Right.
Now, consider the mechanics of their wealth. For a Jamaican American living in Miami, their primary source of wealth, their nest egg, it is usually the equity in their U.S. home.
Right. They might have bought a house in Florida 20 years ago. It's tripled in value, and they feel rich.
Exactly. And often, they use that paper wealth to invest back home. They might take out a home equity line of credit, a Hilo Sion, their U.S. house, to build a villa in St. Anne.
Okay.
But what happens if the U.S. market corrects?
Your home value drops.
Their home value drops. And suddenly, the bank says, sorry, you don't have that much equity anymore, or we are cutting your credit line. That is the wealth effect. Even if their salary hasn't changed, their balance sheet has been smashed.
Yeah.
They feel poorer, and their access to easy cash dries up.
So it's not just that they feel sad about their house value. The actual liquidity, the cash they were going to wire to the contractor in Jamaica, it literally disappears.
That's the key. And the source specifically notes that this doesn't hit every sector equally. It specifically softens demand in the higher-end segments of the Jamaican market.
Huh?
The luxury condos, the vacation villas, those are discretionary purchases. If you're worried about your main house in New York, you aren't buying a second one in Ocho Rios.
That makes perfect sense. So the tap gets turned off. Now, what about the second channel? You mentioned borrowing costs.
This one is more about the global banking system.
Yeah.
Global credit markets are interconnected, like a plumbing system. If the U.S. Federal Reserve keeps rates high to fight inflation or manage their economy, it sets a floor for the rest of the world.
So Jamaica can't just have super low rates if the U.S. has high rates.
It's very, very difficult. If the U.S. pays 5% on safe government debt, an emerging market like Jamaica has to pay more to attract investors. That's the risk premium. This means borrowing costs locally in Jamaica go up.
Which hits the local buyer trying to get a mortgage.
It hits the local buyer,
Yeah.
making monthly payments unaffordable. But I think the more overlooked impact is on the supply side, the developers.
How so?
Imagine you're a developer trying to build an apartment complex in Kingston. You need a loan to buy the materials, pay the workers, get the project off the ground. If the interest rate on that construction loan jumps from, say, 7% to 12%, your profit margin might just vanish.
So you just don't build it.
You pause, or you cancel,
Right.
or you try to pass that cost on to the buyer, raising prices even higher in a market that already struggles with affordability. So you get this stagnation where construction slows down, not because people don't want houses, but because the math just doesn't work for the builders.
Okay, so if I stop reading there, I'm thinking disaster. The diaspora has no cash, and the local builders can't afford loans. It sounds like a recipe for a crash in Jamaica, too. But, and here's where the source material pivots. It explicitly says, hold on a minute. It challenges that idea of a replica crash.
It does. And this is the most fascinating part of the analysis. It argues that Jamaica has certain insulation factors that the U.S. market lacks.
Insulation factors, like what?
Well, the biggest one is leverage. We need to distinguish between a market that's built on debt and a market that's built on cash.
Explain that difference using the current situation.
Think of the U.S. market like buying stocks on margin. You put a little bit of money down, and you borrow a huge amount to control a big asset. If the value drops even a little bit, you get a margin call. You have to sell, or you lose everything. That's the U.S. housing market. Low down payments, high leverage. When people lose jobs, they default, banks foreclose, and that floods the market with cheap houses, driving prices down.
It's a panic spiral.
Right. Now look at Jamaica. Jamaica has a much smaller mortgage market relative to its economy. A significant portion of transactions are cash-based, or they have very substantial down payments.
So if I bought my house in Mandeville with cash that I saved up over 20 years.
You have zero leverage. If the market dips, you don't have to sell. You have holding power. You can just sit there and wait for the market to recover. This lack of forced selling prevents the kind of abrupt collapses you see in the U.S.
I see. So in the U.S., the bank forces the sale. In Jamaica, the owner just shrugs and says, I'm not selling for less than it's worth.
Exactly. That behavior puts a floor under prices. It makes the market sticky. It might stop rising, but it rarely falls off a cliff.
But let me play devil's advocate here. Cash is great, but cash runs out. If the diaspora is squeezed, that cash flow stops. Doesn't that eventually lead to a crash, just a slower one?
It leads to a slowdown, certainly. Volume drops, the number of transactions drops. But crash implies a rapid drop in prices. And that is unlikely because of the other insulation factor, scarcity.
The supply versus demand equation.
Precisely. Jamaica has a chronic housing shortage. specifically in urban centers like Kingston. You have a limited land supply. You can't just sprawl endlessly into the desert like you can in Arizona or Texas.
Right.
And when you have a growing population moving to cities and you physically can't build enough homes fast enough, that scarcity supports prices.
It keeps the value up because there simply aren't enough roofs for the heads.
Correct. And I want to connect this to a piece of breaking news from today that usually gets buried in the financial section. The IMF, the International Monetary Fund, just approved U.S. $415 million in emergency funding for Jamaica.
I saw that on the ticker. That's the Resilience and Sustainability Facility, right? What does that have to do with house prices?
It's critical context. Why did they approve it?
Yeah.
It's largely due to infrastructure and housing pressure caused by recent hurricane damage and climate risks.
Ah, right. We can't forget the weather.
Well, think about what that means for the housing market. You have natural disasters that have damaged the existing stock of housing. That effectively reduces the supply even further.
So the hurricane knocked down houses, making the remaining ones even more valuable due to that scarcity.
Tragically, yes. And the IMF funding is coming in to help rebuild, which pumps liquidity into the construction sector. So you have a situation where supply is constrained by nature and money's coming in to fix it. This just reinforces the argument that prices are unlikely to crash because the availability of homes is actually shrinking relative to need.
I see.
It's a consolidation phase, fueled by genuine need, not a speculative bubble that's about to pop.
That is a really important distinction.
Right.
The U.S. bubble is speculation. The Jamaica pressure is scarcity.
And let's add one more layer to the demand side. There's another item on the sidebar today. The U.S. has lowered its travel advisory for Jamaica to level 2.
I saw that. Exercise increased caution, but not don't go.
That shift matters immensely for real estate. Real estate in the Caribbean is partly an emotional asset class. It's tied to perception.
You mean for the Airbnb investor?
Precisely. If you are an investor looking to buy a property for short-term rentals, your biggest fear is that tourists stop coming. A level 2 advisory gives the green light. It says the tourism engine is still running.
Right.
This potentially counteracts some of the negativity from the U.S. housing crash. Even if your U.S. home value is down, if you see a business opportunity in Jamaican tourism rentals that looks safe, you might still find a way to make that investment.
It's a counterweight.
Yeah.
So we have a tug of war. On one side, the U.S. crash is cutting off diaspora wealth and raising borrowing costs. On the other side, we have cash buyers, limited land, IMF rebuilding money, and a decent tourism outlook keeping the floor intact.
That's a stalemate.
But a stalemate doesn't mean everything is fine. And this brings us to the so what part of the deep dive. If the risk isn't a dramatic Hollywood-style crash, what is the actual risk? Because I doubt it's smooth sailing.
No, it's not smooth. The source is very clear on this. The risk for Jamaica isn't prices plummeting. The risk is stagflation.
Stagflation in housing, what does that even look like?
It looks like prices staying high or even creeping up slightly, while economic growth slows down and affordability evaporates. The source identifies slower growth, delayed projects, and affordability pressures as the real threats.
So for the average person, the teacher, the nurse, the young professional in Kingston, it means the goalposts just keep moving away.
Exactly. If construction costs rise due to global inflation, developers can't build cheap houses. They only build luxury because that's the only place the margin exists. So the market decouples. You have a rich housing market and a poor population.
And that is the warning the analysts are giving. They say Jamaica needs to learn from the U.S. failure.
Yes, the U.S. failed because they allowed home prices to completely detach from wages. They viewed housing as a financial asset to be traded rather than shelter. The expert analysis warns that Jamaica is walking down that same path. If first-time buyers are locked out because financing is too expensive and supply is only focused on the diaspora.
You end up with a social crisis, even if the real estate charts look stable.
Precisely. Stability in prices doesn't mean stability in society. The goal, as the source puts it, shouldn't just be protecting property values. It should be resilience.
What does resilience look like in practice? If you were the Minister of Housing looking at this report, what are the actionable steps?
The source outlines a few. First, diversify supply. You cannot just rely on private developers building high-end condos. There needs to be incentivized, affordable development.
Bread and butter housing.
Yes. Second, land use planning. If land is scarce, you have to use it efficiently. And finally, financial innovation. If the U.S. mortgage model doesn't work for locals, what does? We need models that fit the local income reality, not imported models that rely on cheap global debt.
It's interesting because it flips the script. We started this whole conversation looking for a disaster or crash, but the real disaster might just be a slow, grinding crisis where nothing happens, but no one can afford anything.
That is often how economic pain manifests. Not with a bang, but with a whimper. A slow erosion of purchasing power.
So to recap before we wrap up, the headlines are screaming about a U.S. housing correction due to that unsustainable divergence between wages and prices.
Right. And that correction is likely starting now.
But Jamaica's market is structurally different. It's an incremental market shaped by land constraints, cash buyers who don't panic sell, and specific drivers like tourism. It's a tanker, not a speedboat. It turns slowly.
A very good analogy. But it is sailing into rough waters.
The transmission is real. The wealth effect on the diaspora is going to hurt. The cost of borrowing is going to hurt. It's just not going to look like 2008.
Exactly. The direction of travel is towards a slowdown and tightening, but not necessarily a collapse.
I want to leave the listener with a thought, something to chew on that connects all these dots. We spend so much time working about a market crash. We look at the charts and we're terrified of the line going down. But in a place like Jamaica, I'm wondering if the actual catastrophe is the opposite. Well, think about the decoupling you mentioned. If global inflation and scarcity keep prices rising fueled by that limited land and high construction costs, while the U.S. economy slows down, think about the remittances. Think about the diaspora.
You're thinking about the purchasing power of the external money.
Exactly.
Right.
Are we looking at a future where the diaspora stops buying? Not because they don't want to, but because they simply can't. If the U.S. wallet shrinks, but the Jamaican price tag grows, that gap is where the real story is. If the external money tap runs dry because of U.S. economic woes, but the prices don't adjust down, who buys the houses?
That is the structural test of the decade. If the locals can't afford it and the diaspora can no longer afford it, then the market freezes. That is a scenario Jamaica has to prepare for.
And that is something we will definitely be watching closely as 2026 unfolds. It's going to be a fascinating, if nerve-wracking year. Thank you for walking us through the mechanics of this.
My pleasure. It's a complex picture, but the details matter.
And thank you to you, the learner, for tuning in. Remember, don't just read the headline, look for the transmission mechanism. Stay curious, and we will catch you on the next deep dive.
Goodbye for now.
See you next time.